Good day, good day everyone. Welcome to today's Ascot Wealth Management webinar. Today we'll be covering ISA reforms with our host, Catriona. And we also have a special guest today with us, Sam Hallett. He will be joining in as well. Without any further ado, I'm going to hand over to Catriona, and everyone have a good webinar and enjoy.
Thank you, Sam. Morning, everyone. As mentioned, today's webinar is going to be talking about ISA reforms. This has been quite a popular area of conversation for us in recent weeks, so we thought it's a good topic to run you through. Today's webinar is probably going to be a bit shorter than some of the ones we've done before, just because of the content kind of depth of this topic. So we expect this will be maybe 15 to 20 minutes with some questions and answers at the end. So as always, starting with the disclaimer, this is an information-based webinar. We're not giving any authorised advice here. This is just for your purpose of information. So if you have any doubts or want any more personalised information, please get in touch with your financial advisor. Okay, so at the aim of today, I want to run you through the ISA reforms over these 5 different areas. We'll just talk with a bit of an introduction on why we're here and what sparked this reform. We'll run through the restrictions and who's going to be impacted and what the tax looks like and what some other savings options could be, before getting Sam's take on how this impacts, if it impacts any of the investment decisions he makes in the lower risk part of the portfolio. So to begin with, why are we here? So as we all know, the Rachel Reeves budget of 2025, trying to get the right chancellor now, we've had so many. Rachel Reeves budget of 2025 was a lot of change, some of which was not actually necessarily revenue driving, quite interestingly. This was one of them. So in the budget, she announced that from April 2027, there would be a cap on cash ISAs at £12,000 for anyone who's below 65. And interestingly, when they release the post-budget information, they have an appendix at the back, which always breaks down the expected revenue they're going to get from any changes, whether that's a change to capital gains tax, inheritance tax, or a reform like this. And interestingly, they thought this would cost them money, which I'm not entirely sure how they came to that calculation, but as a side note, I thought that was quite interesting. But the key change was this £12,000 cap for the under 65-year-olds. And a natural question we had as planners was, well, why can't I put my full 20 into a stocks and shares ISA if I'm under 65 and hold cash? Or why can't I put my full 20 into stocks and shares and then transfer back to cash? And naturally, these loopholes were then what was discussed in the reforms. So what we know now is that this is going to be a shift from April. If you are under 65, you'll be caught within this limit. You can do your 12 to cash and your 8 to ISA stocks and shares. And of course, the 20,000 to ISA stocks and shares still apply. So what's actually happening on the reforms? The reforms closed some of those loophole questions we had. So they confirmed that if you are under 65, from April 2027, you will no longer be able to transfer stocks and shares to cash. You still have full capability to go the other way, cash to stocks, but you will be restricted from a movement the other way. That means in practice, if you are in that kind of scenario where you were looking to move to a cash solution, either for a planning timing or an investment decision, you have until April essentially to do that. That transfer restriction will not apply if you're over 65. So anyone above 65, they're deeming more scope for caution. So you've got full flexibility of the 20,000 into cash and full flexibility to transfer between the different ISAs. They also confirmed what the implications would be if you were the investor I mentioned who would potentially do 20,000 to a stocks and shares ISA and hold cash-like solutions. So that could just be holding a provider product cash, or it could be maybe using a money market fund that we use strategically in the core portfolios. And the reforms confirmed that there'll be a 22% tax levy on any interest that's yielded in an ISA that's 100% in cash. I'll come back to that in a moment. Finally, it's worth noting that there was a hint of potential change in the lifetime ISA rules. This wasn't firmed up in the reforms that were released, but there is going to be a future rule of the lifetime ISA legislation, and it seems to be relating on how the government's contribution is paid. At the moment, if you've got a lifetime ISA, you can save £4,000 a year into it if you're eligible, and the government give a 25% bonus on top of that at the point of your investment. So beneficially for savers, that means if you're investing, you can generate the compound growth on the full £5,000 plus government contribution. But the thought is that's going to move towards the government bonus being added at a later date, so point of purchase instead of point of deposit. A little bit speculation there. We don't fully know, but it's just worth noting again, if you've got a lifetime ISA, it's good to know that there is some potential change on the horizon. And as always, it's something to use whilst we've got the current legislation, as unfortunately we can't see it getting any better, at least in the near term. So let's come back to the tax levy, because I think this is the thing that's caused a lot of questions and has actually taken quite a bit of time for gaining clarity, to be honest, from the reforms themselves. So the cash levy, or the tax levy, sorry, of 22% will only apply if a stocks and shares ISA has 100% in cash. So a scenario where this might be likely is if someone is potentially preparing to make a withdrawal from a stocks and shares ISA, and they are slowly coming down to cash, and they've got 100% there ready in money market for them to move house, for example. They're in that kind of holding pen position where they don't need the money right away, but they want to be low risk in preparation. And those are the market who are going to be hit by this 22% charge on the interest made from their cash. The reforms have confirmed that there is no set limit, but if you have a sub 100% cash position, you will not be levied. Again, we don't have a set kind of prescribed figure for this, but it would suggest then if you've got 10% in cash, you wouldn't be liable to the 22% levy. Again, I think this is something that we'll be talking a lot more about in execution in April. Again, I think something that probably is going to need a bit of a prescribed amount to it in the future, but for now it's a bit of a grey area. Importantly for us, Sam will cover in a moment, it means that there is a bit less nervousness on holding strategic cash for a low percentage within a stocks and shares ISA. So where to go from here? I think this is really important because cash is still a really useful asset class. And for many savers, a cash ISA is a useful resource if you're under 65, if you know you're only saving for a short period of time and you've not got any, investment capacity for loss above and beyond that. So I thought, very interestingly, just after the ISA reforms came out, National Savings and Investments were really, really quick on the marketing mailing list. I got an email the same day with them promoting this being an opportunity for premium bonds, which I would very much agree with. We know that the ISAs are a tax-free option for savers, which is fantastic versus just having a standard savings account. But another solution to savings is premium bonds, because they pay their interest as prizes. So if you are in that unique scenario, you're saving for a particular purpose, you've not got the investment capacity, but you need to put away more than £12,000 and you've not got your cash ISA option anymore, the next best thing I would be thinking about in that scenario is a premium bond. You can have up to 50 grand in there, so it's quite a generous sum. It's easily accessible, but not instantly accessible. You're talking a 2 to 3 business day time horizon for withdrawal. And because it's paid as prizes, the the tax regime it works under is the same for competition and gambling profits. So no interest to declare. Because it is based on prizes, the interest rate is variable and it's by no means guaranteed, but it averages about 4.35% as of the 18th when I wrote this presentation. So it's important to know the premium bond options there. I think it's your next best home if you are in that unique scenario. I'll hand over to Sam.
Thank you, Kat, and also thank you, Isa, for declaring me a special guest. Certainly never been called that before. So yeah, just looking at what's available kind of like within the more investment landscape, I was supposed to say like premium bonds, etc. You know, when we're looking at what's going on in the market at the moment, so base rate is currently 3 3/4%. That was held a couple of weeks ago. What was interesting was that the split of the vote was 9 to hold, 3 to 4 rise. So there is a bit of a, you know, a little bit of pressure to rise that. The market is currently pricing a 50-50 chance of a rate hike in September and possibly peaking at 4.25% in the second half of 2027. Personally, I think that those are a little bit over-egged. What we're seeing at the moment, yesterday, the core inflation and the headline inflation figures were printed for the UK. And don't get me wrong, they're above the 2% target, but they're in a reasonable range. And what's interesting is when you strip out the volatile factors such as food and fuel, is that we're kind of at like 2.6% as a core inflation figure, and services inflation is coming down, which has proved to be quite sticky. So I'm not necessarily sure we're going to see a rate rise this year, but market's currently pricing that to be the case. So the question is, do you lock in before rates change in either direction? Well, the chances of rates falling is quite low in terms of on a variable rate. However, you will find like a fixed term product might be a little bit overpriced at the moment. So if you want to do something like that, now is possibly a good time. Something to consider if not in a if not doing something tax efficient and you're holding cash outside of tax efficient wrappers, of course, you need to consider inflation and tax. Inflation, of course, you need to consider no matter what the environment, but taxation as well. After taxation on a 3.9% kind of return money market fund, which is currently going rate, you're left with 2.33% after taxation. So is it a case of, look, you want to hold cash but you don't want to keep it in a wrapper, or do you want it, what it's already within, say, your SIP, etc., you know, to be working that little bit harder? So we'll take a quick look at those. I did have on the y-axis here the products, but I tried to remember which is which immediately off the top of my head. Fortunately, I have my slides on a separate screen here. So if we're looking down at the bottom here, within the SIP, the typical SIP cash account, so you can set up a fixed term savings account within a SIP. Kind of typically at the moment about 2.6%. Trust bank accounts actually return quite a bit less than the rates that you see in the retail market. So that's what's going on there. Second part here is the Bank of England base rate, and just above that is the money market position. One thing that might be worth considering actually is within ISAs, what they've said that won't be charged subject to 22% charge is the is gilts, which isn't surprising. The government don't want to shoot their own foot with regards to losing demand for people buying gilts. So an option there, if you is to hold an ultra short gilt fund, something that'd be very insensitive to interest rate movements. That's coming in at the moment at 4.07%. And then it kind of depends on what level of risk do you want to hold. Obviously, if you're holding cash, you worry that obviously it's quite possible that you want that surety that's going on. if I ignore this middle line a second, go to these 4.3, 4.4%. There are a range of ETFs out there. So an ETF is a listed instrument that holds within it a range of components. So it's like holding a mutual fund, but it's like holding a share. That's a mutual fund. I'm probably explaining terrible, and Cat can do far better if you are a client of Cat's. But where these products, they hold only certain year dated bonds. So the 4.3% one is the 2026 ending dated fund. So if you were to buy that now and hold it through to the end of the year, you know full well you're going to get 4.3% between now and the end of the year. The one above is the 2027 one. So you know for well if you're going to hold it now through to the end of 2027, you will get 4.4%. So that is an option to go out there. But then there's other options to go depending on the credit risk. Gary, seeing your question there with regards to dividends, dividends are not subject to the ICE taxation. The 22% is just very much a case of cash and what the HMRC are calling cash-like instruments. So that's predominantly money market funds. So dividends, don't need to worry about that at this moment until they change. The other thing, we seem to have lost our slides a little bit, but one thing I will also mention is that, of course, the thing to bear in mind with, say, that fixed those bullet shares, those dated bond ETFs, is that, of course, whilst holding between now and their maturity, you know what you're going to get at the end. They will wiggle on their way. They're not going to be a straight line return. So that's something to bear in mind. And of course, like say a deposit, you're going to not have your FSCS deposit protection there. So that's something else to bear in mind as well. There's also a couple of other options in there that I haven't covered, such as floating rate notes. So they're not going to lose value based on any interest rate rises like you have on other bond products within the investment space. You are still subject though to credit pricing changes, so that's something to bear in mind. And also on top of that, at the very top here, just over 6% return is asset-backed securities. So this would be a fund that's made of like residential mortgage-backed securities or commercial mortgage-backed securities. So in a similar way to your mortgage, you take the first hit, so to speak, on any depreciation of your property, heaven forbid, up to the LTV of your mortgage. The mortgage company only takes any hit after that LTV starts getting hit. So in this case, you'd be like the mortgage company, and so the value of the underlying security would have to drop by a significant amount before before the fund would start losing capital value on the price of those. So there's different options out there. I say that last one was probably a little bit more punching, a little bit more for over a longer term, but there's certainly options that we can do within the portfolios that I think are worthwhile conversations to have with everyone. And out there is just a reiteration of what Kat said. Back to you.
Thank you, Sam. We'll hang on a couple of minutes for questions.
There will be a survey shortly after.
See, we have. Sorry, so see, there's one more question with regards to precious metals or funds based on precious metals classed as cash for the ISA rules. No. The volatility of those is way too high for HMRC to consider them to be cash-like.
Sam, we got another question there. What are the implications for over 65s?
More one for Cat, but I think the answer to that is there isn't really any implications.
Yep, no change at all. If you're over 65, you've still got your full £20,000 ISA allowance to use the cash or stocks, and you've got full flexibility of transferring between stocks and shares and cash. So yes, no implications for the over 65s. Again, one area, sorry, I didn't mention is that the flexible ISA rules haven't changed. So I didn't specify just because they haven't changed, but there's no change to the flexible rulings. That means if you take money out of an ISA, you can still put it back in the same tax year. We've just got a few more questions coming in. Someone's typing. ISAs with Nationwide, should we get a certain percentage? Let me read this question through. We have cash ISAs with Nationwide. Should we get a certain percentage of stocks and shares there to avoid? I'm trying to read that. It's not making sense in my mind, Monique. Sorry, unless this is me being a little bit dim here. So anything you've got in cash ISAs with the Nationwide, there'll be no tax on that interest. Anything that's already locked in, no implications. It just means that going forward, you'll be restricted by the £12,000 limit for anything else you can put in. So for example, in 26-27, you've got your £20,000 allowance. You could do 12 to Nationwide, 8 to your stocks and shares ISA, or a split under that £12,000 ruling. I hope answers the question, but anything that you've already got in cash ISAs is, that's not changing. Questions coming in. So Stephen, answers your question. If you've got 30% of your stocks and shares ISA in cash, our understanding is no, that's not going to be taxable. They've not given a prescribed amount, but they've said it's 100%, which will be taxable. We're hoping we'll get a bit more information on that prescribed amount as the years come through. I imagine if it's 90%, they're going to start looking at it, but at the moment, it's just 100% in cash-like solutions.
Yeah, I would say if you're holding 30% cash or cash-like instruments in stocks and shares ISA, the other 70% in other things, you're showing that you are diversified and you're constructing a wider portfolio. And I think it's more, as Kat said, if you're going like 80, 90, etc. +%. Typical HMRC, they tell you things without actually telling you the exact things, and you have to wait for a test case to go through.
Yeah.
Or people actually know what's going on.
Yeah.
Over 65 the 20,000.
Yeah, exactly. And it's worth noting that's in the tax year you become 65. Are there any changes to junior ISAs or lifetime ISAs? No changes have been discussed for the junior ISA at this stage. Lifetime ISA has been kind of flirted with in the documents so far, but there is no official change. The expectation is the potential ruling altering the point where the 25% government contribution is given. There's a question here: if you become 65 in a few years, will you be able to take advantage of the full 20,000 allowance? Hopefully that's what we've just covered there. So when you get to 65 age tax year, you've got your full 20 allowance. And then we've got a question through on the impact for IF ISAs. Again, the rulings are that we are working on a prescribed percentage in cash. So If you had an innovative finance ISA that's 100% in cash, our feeling is that's going to be at risk of the 22% tax levy. But if you've got, say, 10% and there is a clear intention that you're aiming to invest, the rules would suggest that that's not going to be tax levied. But we would very much like to see a bit more of a prescribed percentage to that as the legislation beds in next year. Question here, if someone's got multiple ISAs, does 100% count for one? It's a good question. My take on that would be that they're going to look at each ISA independently, because the tax levy is going to be paid at the provider level. So it's the provider's job to be reporting this to HMRC, not the individual. So my take would be, if you've got one ISA with 10% in cash, they're not going to be concerned about what you're doing with your other ISAs. So do you have to declare what your ISA is on self-assessment? No, it's all being done by the provider. So beneficially, this isn't going to create any additional reporting or administration on the member level, which is something, I guess. So nothing for you to do. The provider will be reporting it, and it will be coming out of the ISA, essentially, in simple terms. It'll be almost like a deduction of the interest, like we used to have 20 or so years ago for cash savings. Which is a system I'm always surprised they don't revert to personally. But there we are. Okay, right. We've got no one else typing, so hopefully we've got through the questions.
Concludes our today's webinar. Thank you very much, Kat and Sam. That was a great watch. Everyone can stick around for the survey. We're going to have a survey. It will be up for about 4 or 5 minutes. So feel free to fill that out. And the recording and slides will be out within the next 24 hours. So thank you everyone for your time, and have a beautiful day further.
Thank you everyone. Have a good day.
Cheers.